Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
I was looking at him and I was looking like, are you crazy? Are you really literally talking about engineering income like that? Buying a rental property and then taking a reverse mortgage against it and then playing in the stock market with the money that you got from the reverse mortgage, hoping you're earning enough to pay the interest rate on the reverse mortgage, and then you can collect whatever left over for income instead of buying the rental property and renting it out and collecting income. I'm Daniel Agemy.
And I'm Andrew Agemy. And you're listening to Financial Strategies with Andrew and Daniel Agemy. As ludicrous as it may be, that story, but today we're talking about creating massive income for retirement. Massive income. And that may be one way of doing things, Daniel, but it certainly is not massive, probably not massive. Number two, it's a lot of hope. There's no guarantees, no promises on that one, right?
And it's a lot of work.
That's a lot of work.
There's nothing passive about that.
Yeah. So where are you today, Daniel?
I'm here in Denver, Colorado. Yep.
All right.
Beautiful, bright, sunny day, and looks like you're traveling the world. You got a big old map behind you.
That's right, man. I'm in the world, right? I'm in the world, in Connecticut today. Yeah, and I'm proud of you, son. I'm proud that you're here with me today, and that we're able to do this. And it's a lot of fun doing this show with you, and getting better and more enjoyable as time goes on. So, this is a great thing that we do for people by creating massive income for them in their retirement, because so many people come in and they're wanting to know, can they retire? Can they retire? And but they don't answer. They don't typically ask the question, which is the most important question: is how much will you have? How much do I have for retirement? As people don't know what people don't know, and that is one of the first questions we ask. What do you need in retirement? And a lot of times people have no clue. And so we do a top-down analysis, simple enough in a conversation, of what they're making, what they're spending, and that kind of thing to come up for what they need. But then the question is, how do we make that happen? Right, Daniel? How do we get them that? And a lot of times they need a lot of money. And how do we make that happen?
And we're saying creating massive income, because we're literally talking about massive income, right? Mm-hmm. When most advisors, when most retail people are talking about income, you can go get treasury, or you can go get money markets for probably about 5%, which is because like the 10-year bonds are not paying 5%. And a lot of dividend income funds are not paying 5%. And even some longer term, like corporate bonds, are not even paying 5%. So it's kind of really wonky, where usually when you think about rates, the longer you go out, the more you get paid, because it's riskier. But right now we're reversed, where shorter term is actually paying more than longer term. And so when we're talking about massive, we're talking about maybe doubling or sometimes tripling what most people are talking about when they're talking about getting you income from your retirement portfolio. And that's why we're calling it massive. And it's without doing all that weird wonky stuff. It's the old-fashioned way. It's not like the scenario in the beginning where you're doing all this weird engineering of income. It's crazy because the amount of risk you're taking on for some of these funds, you'll see like a 12%, and it's engineered. It's buying calls and selling puts and things like that to try to engineer some income, when there are ways you can generate passive income in your retirement portfolio that are far less risk and pay much more. It's just a forgotten art. And that's what hopefully we're going to explain to some people today, the people listening, ways that they can do it, or things that they can talk to their, financial CFO about to help them get that. And if they're their financial CFO and they don't understand these things, then it's time to start asking the questions. Is it time to get a financial CFO that knows how to do these things? But, that's what we want to, that's what our goal is for today.
Yeah, exactly. And, there's a lot of things I can say from what you just said, Daniel. Number one is the thing I think about the client, the client with $2 million worth of assets that's generating $135,000 a year of income from that $2 million. That's massive income, if you ask me, right? That's in the tune of 7% of interest and dividends, or maybe even a little bit over from that standpoint. And then, like you said, what we do, creating a double-digit increase in that every year is what our history has been, which is pretty cool. But so there's a lot of things that come to my mind. And before I, go any further with this, I want to let you know, in our listening audience, you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And today's topic is creating massive income for retirement. And we have a paper that we put together for you to be able to help you and be able to understand these things. And this is called passive income with a P. Today's show is massive income, but this thing is called passive income with a P, that this paper for retirement, so that you can understand how it works and why you need it, and help you understand a little bit more. You can have that for free by calling us at 800-725-7616. Be glad to put that out to you and have for your free copy. So the other thing, Daniel, you're talking about that, for people to talk to their CFO. I mean, I really challenge them on that from the standpoint of, they may call their person a CFO, but I really don't think there are many true financial CFOs out there. They're more financial salesmen or financial professionals, right? But a true CFO is going to educate them in what they really need to, in what's available, so that they can make smart decisions. And too many times, people out there across the board. So I'm challenging people in the audience that, is their person a CFO, or are they just, some kind of financial professional, right? Because so many times they're just pushing product, or they're telling them what to do, or they're making recommendations instead of giving them the universe of education so that they can make their own smart decision with some guidance. So, but anyway, the whole idea about creating massive income is, when you retire, it's not that you need $1 million or $2 million or $5 million. You need a check to replace the check that you're getting from work. And, Social Security will help you with that check, but it's only going to be maybe 30, 40% maybe of what you need in retirement for most people. You might get a pension. Well, that may give you what you need in retirement, but maybe not. And that's where you need, to be able to get income off your investments. You need a check. Then the check is the most important thing. Now, the question is, what size is your check going to be? It's a terrible thing to run out of money. You can, if you want to engineer income by withdrawing money from your account, you can do that. But but Daniel, tell them what the disadvantage is to that.
Well, you increase your risk by doing that, first off. Now, I understand the lure of that, because a lot of people will go through and they'll just look at funds and they'll look at which ones are paying the highest dividends.
Yeah,
and
right.
So you look at this and you're like, I have NASDAQ exposure and it's paying 10%. I mean, that sounds pretty good. And then you look at the chart history and it looks great, right? So I can understand that, but they're not giving you that income for free. So either it's risky and you could lose principal, or you don't have the upside and you're getting the dividends instead of the upside. So it's a lot of smoke and mirrors. And if you don't understand how something works, you probably shouldn't be investing in it. And what's even worse than you not understanding how it works is if the person selling it to you doesn't understand how it works and they're selling it to you, because you're trusting them. And if they don't understand how it works, or they can't explain it to you, you're in big trouble. That's
right. And the big trouble about this whole thing is, you could run out of money before you run out of life. How many advisors does it take? How many bad advisors does it take to ruin a person's portfolio? One. And it could mean the whole difference with how you approach retirement. And that running out of money is not a fun thing, and it's painful. It's painful. So that is the key, is making sure that you're able to create or have massive income. If you do it the right way, you don't need all of what you need. Don't use everything that you make. So you're able to reinvest it and grow even more income for the future and for when inflation happens and that kind of thing. So, but one of the things that people do is do this thing of engineering income, like you've heard us use that word, engineering income versus organic income that's coming from the investment. And that would be the idea of Daniel mentioned at the top of the show, of somebody buying a house, doing a reverse mortgage on it, investing the money in the stock market, doing all these gyrations to come up with income. Maybe it would happen, maybe it wouldn't happen, as opposed to just buying that house and renting it out and getting income. That's right. Organic.
And all the complexity and all the tax consequences and all the hope that is involved in one situation compared to the other. Sometimes the simplest way is the best way, but right. Wall Street doesn't get paid on the simple way. If you go right. buy a corporate bond, some syndicate makes money when the company issues the stock, and there's a little spread when it gets sold. Somebody makes some money, but then it sits in your portfolio and no one gets paid on it. Now, if you have a money manager involved, they might charge you something on that there, but there's no reoccurring fee inside that fund. So why would someone try to sell that to you if they can't make money on it, right? Whereas these crazy funds, think about the work. When we talk about renting out the house, you might pay a leasing agent to take care of it so you can just walk away and not do anything, and they'll collect the rent and they'll take care of the maintenance for you. So you'll pay them something, but that's a lot less fees than paying the bank to lend you the money while you go pay trading fees, and maybe you need advisors to help you with some of right? There's fees on top of fees on top of fees. And that's what we think is egregious, and that's what we want people to watch out for.
Exactly, Danny. And it also, it's time upon time upon time, right? Where you're going to this bank and you're going to do this thing and you're doing this thing, as opposed to just going to a one-stop shop.
For lower certainty, right? For lower certainty.
Well, or for hope. And hope is not a retirement plan. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is creating massive income. We have a book that goes along with today's show, written by our friend Michael Eason, CPA. Michael's put together a great book, classic in our opinions, called Common Sense Income Strategies. All right. Common Sense Income Strategies by Michael Eason. Your free copy by calling 800-725-7616. For the next 5 first-time callers, 800-725-7616. Call now.
Time for some tough questions for these financial advisors. What makes Retirement Income Source different from other financial?
Our extensive experience generating investment income quickly so you can have financial peace of mind, navigate your retirement smoothly, and have more time to spend with family and doing the things you love. Honey. We gotta talk to these guys. We're done here.
This is Financial Strategies with Andrew and Daniel Agemy.
AAA, when I was a younger man moving out to Colorado, got to the big city. It's always funny when people call it the big city to me, being, growing up in between Boston and New York, and then calling Denver a big city is always funny, but moved out to the big city, and a call from what is called a wholesaler. It's someone trying to sell advisors products. And it sounded really cool. It was a product that generated some nice income. Real estate. Everybody loves real estate. He was going to take me to a free lunch and talk about it. I thought it was the coolest thing. So I went, and we went to Cherry Creek and sat down and had a nice meal, and he was paying for it. And he just tried to sell me the whole time, 2 hours or 2.5 hours of trying to sell me this real estate investment trust, where it basically takes all control out of the client's hand. They never know when they're going to get their capital back, for income stream that they didn't know exactly what it was going to be or for how long it was going to be. And I remember leaving that thinking, that was not a free lunch. It's just crazy. And calling you and you were like, yep, now you know. And we get emails from these guys all the time now. That was, I think, 12 years ago now that happened. We get emails from these types of people trying to take us to meals, dinners, everything like that all the time to sell us their products for free lunches. But there's no such thing as a free lunch.
That's right.
I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. So we want to educate you. We want to be able to help you, give you the information you need so you can make smart financial decisions, take out the stress out of retirement. Today's topic is creating massive income for retirement. And we're talking massive. We're not talking a little bit. We're talking massive when it comes to that. And, like the example I gave in the last segment was, of our client with a couple $1 million, $2 million, and creating about $135,000 a year of income off of that $2 million that can go for the rest of their life. That's what we're talking about here, folks, is a check to replace your paycheck at work, not taking from the principal, right? Using interest and dividends. So Daniel, that's a great story, and Daniel's talking about this guy selling them products. He doesn't mean selling Daniel stuff, but selling Daniel on the idea that Daniel would sell clients on that. Well, that fits with the suitability. That's a salesman, and we're not salesmen. We're consultants. We're advisors to folks, and that doesn't fit. When we're talking about investments and income, there's a lot of people out there that will give you income, but they're not going to be massive income, and they're going to tell you a sweet story. It's going to sound great. And I've been in this business. I'm now in my 4th decade in this business, and I've been through a lot of stuff, and I recognize that a lot of things sound a whole lot better than what they actually are. And, you get people telling you all the good stuff about something, and it sounds real good. And people say, yeah, let's go for that. And then it turns out to be something totally different. You think it's the greatest thing since sliced bread. And then later on, you find out, wow, I didn't know about this. I didn't know about that. And all these things come back and bite you in one way or another. And if you have time on your side, you can turn things around and make changes, but it only takes one advisor to ruin a portfolio.
All right. Well, we are focusing on the good stuff, the stuff that can generate income for people. But we want to go through some of what you call the good, bad, or really the bad and the ugly. We're
right.
do the good, but we're not going to spend a lot of time. I call it the Hall of Shame. All right.
Yeah,
if you have one of these things on the Hall of Shame, then you need to reach out to us and talk to us. It may be okay. It may be really bad. And then there's some other things we'll throw in here too that are not bad things, but you could probably do a lot better.
Right.
So some of the things on the Hall of Shame would be structured product. This is kind of one of the things that this guy was trying to sell me. This is something that is designed to take the risk off of the institution that's selling it and put it on the retiree. These are some of the most disgusting things that have been invented because they're literally designed to take the risk from the big institution and put it on the investor. And the people selling them don't usually know that that's what's going on. So if you have structured products, you absolutely need to get a second opinion on that from someone that did not sell it to you. Variable annuities, these they'll put on things called income riders and stuff like that. They usually have excessive fees. The income may look good and they may be okay for you, but you need to get a second opinion because it can eat up all your money in just fees alone. Maybe you have an income, but a lot of people want both. They want the income and they want their principal to give to their children or to causes that they care about.
And that's what a lot of times those variable annuities don't allow for that. They're designed for income, but you're not passing anything on to the next generation, generally speaking. Yeah.
There are any structured product or fund that's using leverage, which you won't really know about. So you kind of have to ask questions. That's using leverage. You need a second opinion from someone who did not sell it to you or suggest it to you. If you have any fund that's buying or selling calls and puts, and you do not understand how that works, you did not pick that out and you actually understand how that works, you need a second opinion from someone who did not sell it to you.
Right.
And then bond funds. Okay. These are used all the time. So probably everyone listening has some of these, but these are something that you should get a second opinion on, because it depends what types of bonds they're buying. It depends what types of fees are internal. And the other difficulty with these is when you buy a bond fund, what you're doing is you're giving up the two most important things, the two most important aspects of owning a bond. You give up the maturity date, which is when you know the company will or government will buy it back from you, and you give up the promise or the guarantee of the income, where they have a coupon on there that states exactly how much they're going to pay to you a year. And if it's in the fund, those two guarantees go away.
All right. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Today's topic is creating massive income for retirement. We got a paper to go along with the show today. It's called Passive Income with a P. The show is Massive Income with an M, and this is Passive Income for Retirement with a P. And love to be able to put that in your hand to be able to help you understand better from that standpoint and be able to use that. So call 800-725-7616 for your free copy. You know, Daniel, you said that probably everybody listening, it has the bond funds, and I take opposition to that, because we got a lot of clients listening. Our clients don't have bond funds,
okay.
So got to keep that in mind, right? So we believe in individual investments that don't have these back end fees on them that like this wholesaler that Daniel's talked about is making money off of, and that the companies are making money off of. Structured products, who makes money on structured products? The people that structure them. Right. And like Daniel said, they take the risk off of the company, put it on the people, and variable annuities are part of that as well. Immediate annuities can be in that realm, because you can lose control on that. And the taxation, you might have increased taxation with immediate or annuitized annuities, or you might have decreased, or you might have the same. It depends upon what's being used for that. The real estate investment trust, the non-traded real estate investment trust, is the guy that Daniel went to lunch with, that from that standpoint. And so and there's some other things besides, but our goal, like Daniel said, is not to focus on the bad. We want to alert you to the bad, say, hey, get some backup, get a second opinion from somebody that didn't sell you that, to be able to give you some perspective on that. But, we've even seen some safe annuities that are bad because they have all kinds of huge fees on them, that when the market was going up, people were actually losing money. And we were able to take those and turn those around to actually where they were in where they should have been, without any problem from that standpoint. But let's get into the good.
That fits into the things that are not necessarily bad, but you could do better. And so there's all kinds of annuities out there right now that have rates from this past decade plus of zero rates. So this is something we weren't going to focus on, but I please listen to this. Listeners, please listen to this. Your capital is more valuable than you think it is. The risk-free rate right now is about 5%. Someone is earning at least 5% on your money. So if you are not earning 5%, either the banker is earning that on your money, or the insurance company is earning that on your money. Okay. And if you don't care about it, your kids do, or someone else in the world cares about that. So at least earn it for them, so that the banker's not taking your kid's inheritance. Okay. Right. This we see all the time, and some people are like, I'm okay with it, and they don't realize it's not like it's not earning the money.
Yeah.
So you might be okay if nobody earns money on your money, right, but somebody's earning it on your money. And if it's not you, that's messed up.
Yeah. Very much.
And then real estate. So people who own real estate, you've done a good thing. You've made a lot of money, but it may be time to reevaluate if it's still paying you the best yield based on the asset value, because we've had a lot of real estate people come in who they could make the same type of money just putting in a money market fund as what they're doing all the rent work to rent it out. Yeah. And that's not even some of the stuff we're about to get into, which is even better than the money market account. But just by putting it in a money market account and not having to do any work, they could earn the same type of return as they're getting right now on the real estate. So these are things that are not bad, but you could do better.
Yeah, good point. Good point. And what I'm going to say to back that up, Daniel, with what you said, when you're saying, somebody's making money on your money, two things, right? Number one is if you're a tither or you believe in giving money away, like the richest man in Babylon says, give money away. If you're one of those and your money is not working so hard, if your money worked harder for you with no extra risk, well, now you have more money to give away, right? And how about that? If you don't want it, well, give it away to somebody that can use it.
Don't let the banker or the insurance man take that money from you.
Yeah,
because they are.
Or the stockbroker. All kinds of people are out there feeding off of that, right? So Wall Street. The second thing. Oh, I forgot the second thing. Let's see. One was that making that. Oh, the second thing is, a lot of you listen to this show have annuities. And those annuities, if you got them 5, 6, 7, 8, 10 years ago, whatever the case may be, they're probably not pushing as much return, as much growth for you as the new ones can do. And you might say, well, I've got fees that I can't get up. Well, there's ways to get around that, folks. And, somebody that's skilled at this can actually help you to do exactly that. So you need to be taking a look at something, maybe getting a free second opinion on stuff, have a financial MRI done on your portfolio to put you in a better shape. And the sooner you do it, the better shape you will be in for retirement or for your latter years of retirement so that you don't run out of money. You're listening to Financial Strategies with Andrew and Daniel Agemy. We have a book that we'd like to give you today by our friend Michael Easom, and the book is called Common Sense Income Strategies. Tells you what we're going to be going into in the next segments of this is how to be able to get the most income, massive income out of your portfolio. And we love to put that in your hand to the next 5 first-time callers at 800-725-7616, 800-725-7616. If you want a free second opinion or financial MRI done on your finances, let the operator know that, or contact us on our website, agemy.com, agemy.com, or questions, let us know that as well. 800-725-7616. Call now.
This is Financial Strategy with Andrew and Daniel Agemy.
So, Daniel, you were just talking about, maybe getting 5% return on interest on money. And, when I'm talking to people about a diversified portfolio, which is what we're going to be talking about in this next segment and two, we talk about, CDs. You could get a 4 or 5% CD, and that's a great thing. And the good news is you're getting 4 or 5%. The bad news is you're getting 4 or 5%. Well, Andrew, what do you mean about that's bad news, getting 4 or 5%? Well, let's say it's a 5-year CD paying 5%. Well, at the end of 5 years, what's going to happen when that CD comes due for 5%? What's going to happen? What are you going to put it in to be able to help you at that standpoint? And we don't know. We don't know what's going to happen. But today we can do some other things. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. What's the big deal with income, AAA? What is the big deal? We're talking about generating massive income today, and we keep hearing about people who are trying to get income. It's all over the internet. People are looking for income. We have people come into our offices all the time. They may not say, I want income, but they say things like, I want to make sure I don't run out of money in retirement. I want to have enough money to live off of. I want to not have to change my lifestyle. They're looking for income. So today, we've talked about some of the Hall of Shame ways of generating income, but now we want to talk about actual ways to generate income. Yeah. And you just went through one of the ways that's possible, which is just a traditional kind of CD. And we're not going to be talking about complex, crazy things today. We'll be talking about simple things like a CD, right?
Right.
But things that can do even better.
Right. And the point is with CDs, it's not, the thing is the strategy you're using with CDs, right? Because sometimes we use CDs for 1 year because, and then they come due and we're able to take that money and flip that into something that's going to make even bigger money. Right. And we're not talking about putting all your money in CDs. We're talking, and all this stuff. We're talking about a diversified portfolio because diversification, like Ecclesiastes 11:1 and 2 says, cast your bread upon the water. After many days it come back to you, give it unto 7 portions, even 8. where you don't know what disaster comes upon the land. So we believe in diversification of investments, diversification of tax strategies and registration, diversification of other, of investment strategies. And so, the first thing is the banks. The banks support things. The banks guarantee money, and that's all well and good. Although, I'm not so certain about the FDIC. FDIC has almost gone bankrupt twice in the past 35 years or so. And if we have another 2008 or financial crisis, they probably are going to go bankrupt. There's not enough money into FDIC. Well, that's where, insurance companies come into play, because insurance companies guarantee money too. And insurance companies has different things, has four different kinds of annuities. Their product is annuities, and the government uses bonds. Well, the difference between annuities and CDs is that annuities, if for non-IRA money, it's tax deferred. IRAs are already tax deferred. CDs are not tax deferred. So you don't pay money. You don't pay tax on the money as it's growing. But there's four kinds of annuities. Two that we don't like: immediate annuities and variable annuities, because both of those, you kind of like lose control. There's fees. There's all kinds of bad stuff happening with those, like Daniel talked about in the first section or two. But then there's what's called fixed annuities that are kind of like the insurance company's version of a bank CD. They're called fixed because the principal is fixed, the interest rate is fixed, and the time frame is fixed. And there's a place for those. Then there's called fixed index annuities. And these are cool because the principal is fixed, but the interest is indexed to the stock market. Your money's not in the stock market. The market goes up, your money goes up, but if the market comes down, your money stays. It only ratchets up. Now, Andrew, it sounds too good to be true. Well, yes, but you don't get, if the market goes up 10%, maybe you make 5 or 6% or something like that. Market goes up, goes up 15, maybe you get 7 or 8 or something. They're going to take some off the top to protect you on the bottom side. And those things also have an option to them that is an income, a guaranteed income for the rest of your life. Even if you run out of breath, that the check will keep coming, and whatever money is left in the annuity will go to your heirs. Pretty cool things that they have available like that. Bonds, government bonds are insured too, but they act a little bit differently from that standpoint. And before I tell you how, or Daniel tells you, I'm going to ask Daniel to tell you how those work. But before that happens, I want to let you know you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is creating massive income for retirement. And we have a paper that we'd love to give you called the Universe of Income Generating Investments and Strategies. Universe of Income Generating Investment Strategies, because it's interest and dividends is key to making sure that you don't run out of money. We'd love to put this paper in your hand. You can call us and get it for free at 800-725-7616, 800-725-7616 for your free copy. Daniel, on Financial Strategies today, tell us about how those government bonds work.
Well, the government bonds, people usually buy government bonds through a fund. And it's funny because typically people are thinking of buying government bonds for growth. And why would I say that? Well, because interest rates have been coming down so much, bonds work like a teeter-totter, like a seesaw, right? When the interest rate goes up, the value of the bond goes down. And when the interest rates go down, the value of the bond goes up. And so for the past, 30 years, 40 years, as bonds have come down, as interest rates have come down, the value of the bonds have gone up. And so people will put on these trades where they are buying a fund just so they can get exposure to the opposite of markets or the opposite of interest rates. That's typically how people think of these. But when we're talking about bonds, we're talking about buying the individual bonds, if that's a municipality or if that is the federal government, where you buy it for a term and you have a mathematically certain return. Now, we don't think that these are the best returns, especially when we're talking about massive income, because It's not super massive. It's probably like, I don't know, 4.5%, and maybe even a little bit lower than that right now for the 10-year. So it's not massive income by any stretch of the imagination, but you're going to get your principal back. We don't know what you'll be able to buy with the principal in, say, 10 years, the way we're creating money, but you will get your, we have a money printer, right? The US government has a money printer. You're going to get your money back.
Right.
And then municipalities kind of work the same way. And remember that feature of it works like the seesaw. When rates go up, the value can go down. And when rates go down, the value can go up. So you can get appreciation. You can watch the value come down, but that doesn't matter because at the end of the term, the municipality, the government, or the corporation is going to buy it back from you and you get your principal back. So that does present some opportunities for getting capital appreciation on top of your interest rate. And there's some unique ways of doing that we like to implement. But I think that, and then, another way of using government bonds is through a money market fund, right? Where the money market fund goes and buys short-term treasury, usually bills, but sometimes it could be notes and things like that. And so you package a bunch of these together and you have money markets is paying about 5% right now. You can have no volatility in the fund and collect 5%. So this is something that has not been available to people. And some people don't even know it's available to them now.
Right.
But this hasn't been available. When would you say? Like, what, 2007 or 6 or 5? Yep. That's been since the 5% in a money market has been available.
Yeah, exactly. Yep.
So people don't even know they're available. So if you've got a lot of money in the bank, you're saving it up for your wedding, you're saving it up for a house, whatever. Some thought is to look at putting it into a money market fund where you could get something like 5%. And, it's especially in these government ones, there's no FDIC insurance behind it, but there is, you're buying treasuries that are backed by the United States government.
Right. Good stuff. Good stuff. What I like to say, regarding the government bonds is, you buy a $10,000 bond and let's say you get 4% on it, and how they work is, practically speaking is, you hold it to maturity and how much you're going to get. It's $10,000 bond.
It's not a trick question.
No, it's not a trick question. $10,000. I know. I get that all the time from people. It's cool when some clients, I ask them that question and the wife says, $10,000. I said, good job. You've been paying attention to me. And, and you're going to make $400 a year every year until it matures. So pretty good. But the rub comes in if you want to get out of it prior to that 10-year period of time. And the question is, you just can't, cash it in. You got to sell it. And if, interest rates are 7%, nobody wants a 4% bond. So maybe you get $9,000 for your $10,000 bond. If interest rates are 1%, everybody wants a 4% bond. So maybe you get $11,000 for your $10,000 bond. Now, that's one of the things that we do is watch to see what's happening, because if we can sell it for $11,000 and we can buy something else that's going to make you more than 4%, well, we may very well do that from that standpoint. And that's the thing about having a good, somebody that's going to be able to watch the money be able to happen. But that's important to be able to understand what Daniel said about the seesaw, the teeter-totter with rates and principal, as well as what I said, because, we're going to talk about, when we come back from break, we're going to talk about corporate bonds and some of those other things, how you can create massive income. But one of the key things about creating this massive income is getting somebody that knows what they're doing, that is watching it every day to buy, to sell, to put you in a better position, either to protect your money more or to help you make more money. And that is the key factor. And that is what Agemy Financial Strategies does for its clients. So you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is creating massive income for retirement. glad that you joined us. We have a book to be able to give you today by our friend Michael Easom called Common Sense Income Investing. Michael's done a great job of writing this book, and it gives you the ins and outs and these things that we're telling you about and more information about them so that you can understand how they work and be able to, be educated so you can make a smart decision. So when somebody's coming to you and saying, hey, you get this ETF, that has these bonds in it, well, no, that's not the best thing. That's not going to create the best environment for me. So you can have it for free by calling us at 800-725-7616. The next 5 first-time callers, 800-725-7616. Call now.
Important financial questions. Are you feeling confident that you have enough money saved to enjoy a stress-free retirement?
Honestly, I'm not sure.
That's where Retirement Income Source's investment advisory arm comes in. We exist to help you invest your money smartly.
I'm struggling to accept my retirement without a steady paycheck. So can you help me invest into a profitable revenue plan?
Absolutely. We have top advisors nationwide who have a fiduciary obligation to you, helping you generate retirement income.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
AAA, there's two people, and they're both trying to go and buy a house. Now, one of them has a credit score of 698, and the other one has a credit score of 700. Now, for people who are not able to visualize that, that's 2 points different, 698 or 700. The bank they're going to says that if you have a credit score above 700 or above, then you are a low risk investor. And if you're below 700, then you are a high risk investor. And for 700 and above, the interest rate is 5%. And if you're below, it's 7.5%. So the first investor with the 700 score goes into the bank and is thrilled to death to get a 5% interest rate on their new house. The second investor with the 698 credit score is really upset because they have to pay 7.5% in order to get the same mortgage for the person that has 2 points higher. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew Daniel Agemy, because people don't know what people don't know. Today's topic is creating massive income or retirement. And income is a very important part of retirement, because who cares if you have $1 million, $2 million, $5 million, $10 million? What matters is how much of a check you're getting every month to replace the paycheck that you're not getting anymore. And that's what we mean by income. Like in the old-fashioned days, getting interest off your bank account, not living off of the principal, but getting the interest and living off the interest. So, Daniel, that's great rendition. I know where you're going with that. So why don't you continue with the rest of the story there?
Yeah, well, we've been talking about some different income streams so far, some different ways of generating income. And people say, your show is called Massive Income. What are you talking about? You've talked about like 5 to 8% so far, right?
Right.
And I would say to you, that's pretty massive compared to what I've seen a lot of people come in with.
Right.
Number one.
Right.
There's plenty of people that have $2, $3, $4, $1 million in the bank, which, by the way, if you're over $250,000 in the bank, you need to change your strategy, because that is not safe. I promise you, if you're over that limit, the banks are changing rules to do bail-ins, and we don't have time to get into that right now. But you're not safe if you're over the FDIC limit in the bank. But if you're doing that, you're getting maybe 1%, but you're probably getting like 0.2% compared to the money market fund we just talked about, 5%. That is massive, right? How many X is that return more?
Right, times, right.
Yeah. So that's that. But now we're going to get more into the fun stuff. And that's what we're talking about, these credit scores, because this is kind of the way markets work. All right. And why do I say that? We're going to do a show on passive flows, so be watching for that. But passive flows have totally changed the dynamic of markets. And so what happens is, if you have that 700 plus credit score as a corporation, you're called investment grade. That's BBB, right? If you're under BBB, if you're BB plus, you're non-investment grade. If you're BB, 3Bs and a minus, you're investment grade. Or 3Bs, you're investment grade. And what that means, you get to go on all the investment grade bond funds. And there's a lot of them. If you're right under that, you cannot be in the investment grade bond funds. And so it's literally that kind of gap where you could be earning 4.5% or 5% on your money compared to 7.5% on your money, just because of that tiny difference. Now, a lot of these companies that are the BBB or the BB plus are actually investment grade. The rating companies just haven't upgraded them yet. They can't keep track of all these companies. They're not looking at these every day.
Right.
And so you can buy an investment grade company that doesn't have the stamp investment grade on it, and it's not in all the bond funds yet, so it hasn't gone up in value. Right? It might have an investment grade bond. It might have an investment grade from another rating agency that's not the top three because they're reviewing it more often. And so what does that mean? This is some of the more exciting, some of the stuff. So now we're talking maybe 7.5%, 8% in a corporate bond, which works the same way as these other bonds we've talked about, where you buy it, you hold it for 4 years, and they buy it back from you. You collect the interest in the meantime. Well, what happens if this other rating agency is right, and this BB plus bond is actually an A bond? Yeah. Well, when Moody's or S&P or whoever decides that it's investment grade, all the bond funds have to buy it now. And what do you think it does to the price of the bond? Right? Yep. Whereas when you're the other way around and you own, let's say, a bond that Moody's has said is BB, 3Bs and a minus, and it's in all the funds, and it gets downgraded to a double B, what do you think happens to it? It has to be sold out of all the bond funds. So if you own that in the bond fund, you're selling it and you're losing money. You're not doing it. The bond manager is doing that. Now, this is where you can get some alpha. You can get some extra oomph on your money without taking on more risk. It takes a lot of work, but I think it's worthwhile. It's a way that you can arbitrage these rating companies.
Nice. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is creating massive income for retirement. We have a paper to go along with today's show to help you understand these things we're talking about even better. It's called Understanding the Universe of Income Generating Strategies and Investments. You can have that for free by calling us 800-725-7616 to be able to help you educate yourself so that you can be and make smart decisions. Daniel, when we're talking about that, those are great things. And that helps us to be able to make more money for people, and understanding when to buy those and watching for when to buy those and getting in and out and having the rating companies so that we can be ahead of the curve is significant.
Yeah,
right?
we've had quite a few bonds this year that got upgraded from those things that they're called like fallen angels, where it's right under that investment grade. We've had multiple bonds this year that they finally caught up and they upgraded them to an investment grade. And you know what it did to the price? It made the price of the bonds go way up, because now these passive flows, money, we call it dumb money because no one's thinking, is this a good investment or a bad investment? It just has to go into something, right? Yeah. And so that's something that's a really cool way. And when you buy a bond under par, so that means, par is $1,000. We talked about that. The company, you buy a bond for $1,000, it gets bought back from you in 4 or 5 years at $1,000. When you buy it under par, it lowers your risk potential tremendously. Why is that? Well, because the only way you lose money in one of these bonds when you hold it to maturity is if the company goes bankrupt, right? And what happens in bankruptcy is they either restructure the company and the bondholders become the owners of the new company, or they sell everything and they pay out the bondholders' money. So when you buy under par, your hurdle rate is if there was a bankruptcy is lower, because if you only paid, let's say, 70 cents on the dollar, that means you only need 70 cents of return when they liquidate everything in the company to get your money back. If you pay over par, it increases your risk potential, because now you need them to pay you not a dollar for a dollar, you need them to pay you $1.25 for the dollar, right? So that's one more risk when you're talking about bond funds, because the bond manager typically is not looking for a good deal on bond. They just have to buy investment grade bonds. And a lot of times, because of the market caps on these things, they have to force money into bonds that are doing better, which means if it goes above par, they have to buy more, which is the opposite of kind of what you want to do with your bonds. You want to buy bonds under par, not over par.
So bottom line is, who makes money in those deals? The client does, the person that owns them.
Yeah.
Right. When they're going up and whatnot.
And this is not hope again. This is not a hope strategy. This is a mathematically certain strategy, because we can do the math and know exactly how much you're going to make in what time frame. Now, it could do better than that. Yeah. But that's one of the things that's a little bit more exciting, and it's still simple. I know that might not have sounded simple, but it's simple where you can lay it out mathematically and just look at it. There's no hope, there's no schemes behind the scene, there's nothing like that.
Yeah, you know what I would do. You know how I use the chicken and the eggs, right? So you basically what you're saying is, the chicken was skinnier. We bought it while it was skinnier, and it's paying a 6 or 7% egg and an 8% egg, and then it gets bigger. So and then so the value is worth more from that standpoint, and it works really well. And then there's those common stocks that pay dividends that you still got a lot of upside for growth. Right. But you're still getting 5 or 6% or whatever as far as dividends go. So they're more risk, but we put lesser in those than maybe some of the safer things. But it increases the potential for the whole portfolio getting bigger as well as giving income. Right.
Yeah, I don't think we need to spend much time on dividend stocks, because most people know that's not a new thing to them. Maybe some of these corporate bonds, right? People don't understand that they can invest in them individually.
Yeah, they don't.
And then preferred stocks, which is another thing we really like, which is kind of a niche market. And these pay typically even better than the corporate bonds because they have longer maturity dates. But it kind of works like a hybrid between a bond and a stock. There's two different kinds. There's preferred stocks, which typically don't have a maturity date, but they have a coupon that's stamped on the stock certificate. So say it's a JP Morgan 6% preferred. There's a possibility they could change that, but it's stamped on the certificate. So most likely you're getting that 6% preferred. It's promised to you that you're going to get that 6%. It's not as robust, secure as the bond, but it's promised, and it gives you a lot of flexibility. What I mean by flexibility is you can buy these things under par and write them up. They're an interest rate play in my mind. But there's also what's called a baby bond, and that's just like the preferred, but it has a maturity date. So it might be 10 years out in the future. And so these things trade like stocks on stock exchanges.
Yeah.
But they work more like a bond where it has a par value where the company will buy it back from you. And so they don't fluctuate a lot. They pay you these big fat dividends. Now we're buying them preferreds because of where rates are, paying 8% dividends. That's a nice juicy dividend for something that has
massive
lower volatility and less risk than a common stock, right?
Yeah. Well, Daniel, it's been great, but we're out of time. And the whole point to this that we're trying to tell you in our listening audience, you're listening to Financial Strategies with Andrew and Daniel Agemy, creating massive income for retirement. It's been the title of today's show. We're just trying to show you there's a lot of ways to be able to get it done, but don't try this at home, and get some more education. And we've got a book to be able to educate you further on this. And it's called Common Sense Income Investments and Strategies by our friend Michael Eastham, CPA. Michael's done a great job of explaining in detail how these things work, and that you can, along with what Daniel has said, listen to the show on anywhere you listen to podcasts, can re-listen to it. And we'd love to be able to put this book in your hands. To the next 5 first-time callers at 800-725-8255. 7616, 800-725-7616. And we look forward to being able to help you to invest for the I and the G.